So the Federal Reserve just bailed out the repo market for the first time in about 6 years. Now, this is really, really important, and it's going to have massive implications for, in particular, monetary policy, but also the American economy on the whole, and then as likely that's going to ripple out and have huge implications for other countries' economies, inflation, asset prices all over. So in this video, I'm going to run through exactly what just happened, what this bailout amounted to, and how you can protect yourself and what you should expect coming forward. Now, first of all, a quick explanation of what the repo market is, because I see a lot of people make a really, really big mistake here. A repo is just a short-term secured loan. Basically, a bank sells a security to someone else, and they also make an agreement to buy that same security back at a later date at a slightly higher price. Then the original seller buys that security back at that higher price on that later date. Basically, that higher price is like paying a little bit of interest on top. Now, in this context, and what most people are talking about when they are talking about the repo market, is the bank just giving away for one single night because they've just got too much cash on hand. And that's something I see a lot of people wonder. Why are banks selling these assets to promise to buy them back one day later at a premium, paying interest on top? Well, because the banks are using the repo market to manage liquidity and collateral for themselves. Say you're a bank with too many securities and not enough cash for the regulatory standards that are around, well then you can sell some of those securities on the repo market, but you want to keep them, so you get them back the next day, paying a small amount of interest on top for the privilege, and you get enough cash to be collateralized, so you're staying within regulatory standards. Or it works the other way around too. You make a little bit of interest when you have too much cash and the money isn't just sat in the bank's account doing nothing, and you're helping other banks to stay liquid as well. But when we talk about the repo market in this context, we're not really talking about one bank lending to another bank. We're usually, almost always in fact, talking about the Federal Reserve intervening within the repo market because there's problems at hand. And that's exactly what's going on here. Now, also a quick note on the reverse repo market. Again, this is actually the same repo market we're talking about, but we're talking about the Fed's interaction in the repo market operating on the other way round. So when we're talking about the reverse repo market, we're talking about the Fed taking liquidity out of the markets, away from banks, because they have too much cash and they don't have enough securities to buy and put that cash to good use. So the Fed does a reverse repo agreement with those banks, taking cash off them overnight and giving them a little bit of interest each time. And this basically happens whenever there's loads of money printing and there's excess cash in the system due to inflation. Now, normally, the repo market runs independently, right? One bank has too much cash, one bank has too much collateral. They use the repo market to fix each other's problems on a day-by-day basis, and both can make a profit with that excess cash or stay collateralized and safe. And so there's no need for the Fed to do anything. And that's exactly what you can see on this graph right here. This is the Federal Reserve's intervention in the repo market over the last 5 years, and you can say it's been pretty much nil, non-existent, until 2 points pop up. We have September of last year here, where the Fed had to intervene with $2.3 billion. And then much more recently, we had just over a week ago, where the Fed had to intervene with $11 billion. So what exactly happened with that? Well, the repo market essentially failed to be self-sufficient. A bunch of banks out there needed enough cash to remain collateralized, and they went to the repo market to get it, but there weren't enough other banks willing to buy their securities to give them that cash. So the Fed had to jump in and add $11 billion worth of liquidity over one night to cover that shortfall. Otherwise, a bunch of banks would have been uncollateralized, and they would have been at risk of regulatory problems and even at risk of a collapse. So basically, we saw the Fed bail out the repo market to the tune of $11 billion. Now, this has happened before, but not recently. If we take a look at this graph here, this shows you the repo market and the Fed's intervention in it over the last 20 years, pretty much, a little bit more than that. And you can see that actually this intervention was really common in the run-up to the global financial crisis, because we didn't have this 0% interest monetary policy where money was just being printed from thin air and thrown around the world. And so it was quite common for banks to not be able to get their collateral or their cash needed from other banks. Interest rates at 0%, mass money printing was rare back then. So there just wasn't enough liquidity in the financial system to handle that. After the global financial crisis, you can see, we're doing what's this, 10 billion in a day, we're doing 11 billion in a day, we're doing 8 billion in a day, constant intervention to keep these banks liquid. The global financial crisis starts, this shaded part here is the recession, and you see that suddenly that intervention stops completely for almost an entire decade. That's because there was loads of liquidity after the global financial crisis, right? The money printers were turned on, interest rates were at 0%, so there was more than enough money to go around for the banks to be handling this liquidity problem on their own. The first time we then saw more problems of this was in 2019, where we actually saw massive intervention, over 5 years ago now. Basically, the government massively increased their borrowing, and the quantitative easing, the money printing that they'd been running over the previous years, had essentially dried up. It had all been run and allocated and made its way into the financial markets. And so then there were these massive liquidity problems, and banks were on the brink of collapse. So the Fed had to come in and do massive bailouts. And then, of course, we had COVID, where once again we had quantitative easing on a massive scale, money printing and 0% interest rates, which then removed that entire liquidity problem. And that really leads us to what happened over the last year. This was the 2019 intervention was that first massive intervention that we'd seen since the global financial crisis. And then we saw another large intervention just about a year ago now, as we see on September the 30th of 2024. That $11 billion in repo agreements in a single day was because the banks just didn't have enough cash to hold themselves together. It wasn't quite as bad as the situation was in 2019, but it has now accelerated. And a year later, we have another massive intervention, $11 billion, getting larger and also getting more frequent as well. It's very, very likely that this isn't just a one-off, because this cash that's needed for these banks and their collateralization isn't going to pop out of nowhere. It needs to be created with monetary policy to keep this system functioning. And without that cash, some banks would literally collapse overnight. After this intervention in 2024, September of last year, the Federal Reserve then went to go on and cut interest rates by almost 1% and to slow down their quantitative tightening as well, which created more liquidity in the markets and freed up more cash for the banks. So the Fed didn't need to run that intervention for the best part of a year. But just like how that all that quantitative easing and money printing dried up after the global financial crisis, and we led to that crisis in 2019, we've seen the exact same thing happen here. Interest rates haven't been dropped in more recent months, and as a result, there's another liquidity crunch within the banks. Now, what does this really mean for us, and what does this mean for the economy going forward? Well, actually, this isn't the worst thing in the world, and it's likely going to lead to a boom in asset prices, though an artificial one, not one based on actual wealth creation and innovation and people getting richer, mostly due to inflation. Inflation right now is actually rather low, 2.4% at its current rate. Yes, it was rising a little bit over the end of last year and went back up to 3%, which was worrying, but by and large, the Fed is much more comfortable with the level of inflation that we're seeing, as are most people in America. However, there is Trump's big, beautiful bill coming into force, and there's going to be a massive increase in government spending going alongside that at a time when all that excess liquidity in financial markets has already dried up. And we remember when we go back to 2019 and we saw the Fed having to bail out the repo market then as well, a big reason for that was there was a massive increase in government expenditure, which dried up liquidity. Now, asset prices are currently high, a little bit unsteady in fairness and faltering at times. Housing prices, for example, in the majority of US states are now actually falling, and the stock market itself has been incredibly turbulent, but it's not the end of the world quite yet. This bailout of the repo market is going to have some very, very important things for us, though. The first one is that actually the Trump's already been desperate for the Federal Reserve to start reducing interest rates and, turn off their quantitative tightening and turn on the quantitative easing quite a lot recently. Trump's easiest vote winner, and one of the reasons he is such a powerhouse when it comes to elections, is that people genuinely believe that with him in power, Americans will get richer. And so he really, really wants to see that happen. And the easiest way to do that, frankly, is to inflate asset prices with cheap money. The US dollar is still the world reserve currency. Yes, it's been losing ground in recent years, but they do still have the ability to print money, and it mostly impacts the money supply available in foreign countries and not quite Americans on paying for food and rent and things like that. So alongside that, we have the turbulent market from trade wars. We have inflation actually rising a little bit last year and then falling again. And then massive government spending increases incoming. Trump is putting a lot of pressure on the Fed to lower rates. And now this bailout of the repo market is going to put even more pressure on Jerome Powell and the Federal Reserve to lower interest rates as well. So what are they thinking about? What's the Fed thinking about when they're looking at this? Well, really, they're trying to balance liquidity concerns first and foremost with the repo market and banks all across the United States. If the repo market didn't exist, banks going bankrupt and there being bank runs and all sorts of things, that would be a far, far more common occurrence, and it would be massively destructive for the American economy. Also, the Federal Reserve is going to be looking at inflation and noting that, sure, it's not quite as low as you'd want it to be when you start slashing interest rates very quickly. It's not below 2%, but it is low enough that actually they've got a little bit of leeway here to run some rate cuts, especially if it helps in other areas like growing the economy and increasing liquidity in the banking system. What I see is likely interest rate cuts to the tune of 1 to 2% over the next 12 to 18 months. Keep in mind that this is a slow process. We're not going to see interest rates drop by 1% over a single quarter or anything like that, because Jerome Powell is absolutely terrified by the mistakes he made during COVID, and he really doesn't want to go down in history as the Federal Reserve chairman who destroyed the American economy and caused inflation to run rampant for years and decades and decades. The next thing I see likely happening is that the Fed is probably going to stop quantitative tightening. Now, this graph here is the Federal Reserve's balance sheet over the last decade or 2 decades or so. And you can see, we all know exactly what it looks like, right? It's been rising consistently for a long time with small parts of quantitative tightening, where the graph is going down. That's the Fed pulling assets out of the economy, basically reversing money printing. And then COVID came and we saw a massive explosion. Over the last 2 or so years, we've seen quantitative tightening happening more on average than quantitative easing. Now, that can historically take place in a few different ways, but the way the Fed has actually been doing it is they've just been letting a load of their government bonds, treasuries expire without releasing as many new ones to fully replace them. So the amount of money printing going on is at a much, much lower rate. And when we see this graph go down, that's essentially the money supply reducing, which has deflationary effects on the economy, but also degrowth effects on the economy. I am pretty firm in my belief that this quantitative tightening is going to stop. They're going to continue to slow it down, and it's going to end up flipping back and reversing and turning back into quantitative easing, where they're releasing money into the system and basically printing money, increasing the money supply. Why will they do that? Because there's not enough liquidity in the markets, growth is a little bit low, and interest rates will be lowering as well. So this quantitative easing, this flood of capital into the markets is pretty essential to keep banks solvent and to keep the repo market from needing this Federal Reserve intervention to keep it functioning. Now, I see this a lot, people talking about, in particular, Trump's beautiful bill and saying it's brilliant because he's lowering taxes. But at the end of the day, this will cause mass levels of inflation, both from what Trump's doing and from what the Federal Reserve is doing. Money printing, quantitative easing in this case, always leads to inflation when it happens at a rate faster than the economy is actually growing. If the money supply increases faster than the growth of an economy, you will see inflation. The same goes for 0% interest rates, or basically free money. It incentivizes lending from banks, it incentivizes borrowing from people who are looking for money, and it leads to inflation. Now, the housing market is currently in a little bit of turmoil. I've made a few videos about this over the last couple of months, and actually it's really not looking good. Some cities like Miami are seeing catastrophic drops in asset prices in terms of housing, and then more than 2/3 of US states at the moment have seen house prices fall over the last year. So this QE and interest rates being cut will help to stimulate the housing market and get you more consistent gains and protect asset prices a little bit, which on the whole will help to protect American wealth, because an awful lot of wealth is held in real estate in the States. We're also likely to see more consistent gains in the US stock market, just like what we saw in the outbreak of COVID, when there was all that money floating around the economy and nowhere to put it. people just started flooding it into stocks, and they flooded it into other investments as well, things like gold and cryptocurrency. So we saw these traditionally risk-off assets where in reality you would expect gold to rise when inflation rises and maybe gold to do worse when stocks are doing well. In reality, that whole relationship got destroyed by the massive amounts of money printing in the post-COVID world, and we saw risk-off assets move in the same direction as each other, which really isn't what we expected. We're likely going to see something similar over the next couple of years as well, where we see just a mass asset price boom all across it. However, the majority of these gains will be artificial and in reality due to the devaluing dollar, not from wealth, not from productivity gains, not from businesses, making more in terms of their profits, just from the valuations of those businesses and assets rising instead. Now, I do want to be clear on that too. Inflation of asset prices itself is inflation. It's just not necessarily measured in the CPI. But if you have the PE ratio of an index like the S&P 500 rise from 20 to 30, in reality, your dollar is getting you less of a business at a 30 PE than it did at a 20 PE. The same happens for valuations who are trying to raise valuations for startups who are trying to raise venture capital, or for small businesses that are being sold to private equity or anything like that. When you see the earnings of these companies remain stagnant or grow at a modest pace, but the valuations of the companies and other assets as well rise at a much, much faster pace, that is inflation, because the earnings that you're making from these assets in real terms, right, whether they be dividends or rents or profits from a business, or even things like Bitcoin mining, the profits that you're getting from the money you're putting in are falling. So we are very likely to see inflation in asset prices, which will create artificial wealth and will give Trump a fairly large boom in his reportings and his pollings. It won't actually make people richer. Now, we're also, of course, likely to see inflation in CPI measured metrics as well, things like foods and housing and cars. But not going to elevate to that ridiculous level we saw during COVID, where stated figures were touching 8% and real figures were above 12 or 13%. But as is always the case, when you increase the money supply, you end up increasing demand as well. Artificial demand, but demand nonetheless, and prices rise as a result of it. Now, the next thing I want to talk about is that there are going to be some problems here, because true taxation is really just government spending. And there's a lovely quote here from a very, very famous economist called Milton Friedman. And he writes as follows, as you can see: keep your eye on one thing and one thing only: how much government is spending, because that's the true tax. If you're not paying for it, the form of explicit taxes, you're paying for it indirectly in the form of inflation or in the form of borrowing. The thing you should keep your eye on is what government spends. And the real problem is to hold down government spending as a fraction of our income. And if you could do that, you can stop worrying about the debt. Obviously, the US national debt is a massively contentious issue. It's one of the reasons that Trump and Elon have had this massive falling out over recent months. I'm going to make a full video on that hopefully over the next week or two. But in essence, what this quote states is that just because your taxes aren't rising, and in fact for a lot of Americans taxes, explicit taxes are going to be falling over the next year, government spending is rising, and that government spending has to be paid for with something, either in the form of debt and then the interest on that debt, so paying taxes on it in the future, or in the form of inflation. Because when a government prints money, that wealth, that newly created wealth gets pushed into the government's coffers, and then that value of the wealth that you have is taken out. So if we have that increase in spending with no increases in tax, inflation becomes the tax. And at the point we're looking at the US today, inflation really is the only real way to pay off the national debt. So it's likely even a conscious decision at this point to tax people through inflation, through the raising of government expenditure. Now, there's another really, really interesting post I saw here, actually on X the other day, from an entrepreneur here in the UK called Daniel Priestley. So what he says is, think about tax revenue from first principles. If government spending is 25% of GDP, you can imagine 3 strong people carrying a 4th person. pretty easy to do. In fact, you can easily share the burden and move fast. If government spending is about 35% of GDP, you can imagine two strong people carrying one person. It's still fairly easy. If government spending is 50%, then you can imagine one strong person carrying another person on their back. This is where it becomes exhausting. The person doing the lifting starts to think they should leave the race or ask to be carried instead. Currently, the UK government spending is 45% of GDP. Now, to be perfectly clear, the US is not in as dire a situation as the United Kingdom is right now. Currently, your government expenditure to GDP is about 36%, still a fair bit larger than it should be for a very healthy economy, but nowhere near as bad as the UK at 45% or a country like France at 55%. But things are going to get worse, and government expenditure is going to increase as a proportion of GDP under Trump's new big, beautiful bill. So that is something to very clearly keep on your mind. Now, what this really means is that we're going to see a boom in asset prices, but it's not going to be a real wealth boom. It's just going to be a boom in valuations. Yields on assets will likely fall over the next couple of years as people feel like and think they're getting richer, but that's just the increase in valuations, not actual tangible wealth, productivity or innovation. Interest rates are going to be falling, but probably not all the way down to zero. I anticipate they'll get to about 2.5% before they end up having to rise them again when inflation spikes again in a couple of years. And the big concern that I have for the American economy, and I think most Americans should be acutely aware of, is the risk of stagflation over the coming decade. The act of government, spending more and more, taxing more and more and paying more and more on their debt, and inflation happening at the same time as that economy is stagnant as a result of too much government intervention. It's a little bit of a dangerous time, so do keep an eye out for it. Of course, this is, again, a little bit of a new format for me. If you like this format of the video where I just have some talking points that I cover and I have a few slides to show you, then please let me know. Leave a comment down below in the description and I'll keep making videos like this. Or if you're some of the people who would rather the old style, where it's a shorter video, maybe 10 minutes in length and not 22 minutes, then let me know that as well, because I'm really trying to get back into Stoic finance and keep giving you guys value and learning and teaching and just keeping an eye on the world with you more and more. So I'm trying to find out the best way I can provide that value and give you guys great content in also a way that's a lot easier for me to put a video together. I used to script out all of my videos word by word. It would take me like 8, 10, 12 hours just to write the damn video. Then it went through the whole editing process and I'd improve it and make changes and take things out and put them in and everything. And so a video like this is much more efficient for me to be making, and the aim with this whole thing is that I'm able to make more content as a result of that. So if you like this content, please let me know. Drop a comment down below, give the video a like or something, and I'll go through and read it all and act upon the advice that you will give me. Other than that, stay stoic, and I'll see you for a future video, hopefully in a couple of days.